Hey Alex, how you doing, sir?
I'm doing well. Can you hear me?
I can, yes, sir. We'll get started in a little bit.
Okay, very good.
I don't know, John, if you can make me host. I am now the host. Look at that. I'm in charge. Pretty scary, isn't it? Where about you from, John? Or sorry, Alex.
I'm from California. Uh,
Whereabouts?
near I'm near Los Angeles. I'm in Canoga Park, actually.
Oh, okay. Awesome. Well,
Yeah.
thanks for joining.
All right, my pleasure. And
Is
I've
this
been
your first time here? Because I don't recognize you, but that doesn't.
yes, it is. It's my first
Awesome.
time with Massive Capital. I've been to a meeting, physical workshop, and then I missed out asking information that I needed at that time. And so I wanted to join you here so I could get that information from you.
Oh, okay. What did you need?
Well, I realized that you guys may be able to come up with an investor, a joint venture partner for me that would possibly come up with the down payment and closing costs to a super large multifamily building or office building. And I was wondering if you guys were also going to supply the LTV, or is that something that I would have to do?
So right now we're not doing partnerships outside of our group. So right now it's only within our main group.
Yeah, well, that's what I want to do. If I have to join the main group,
Yeah.
I see. I have to be in your group for a while in order to be considered
Yeah,
part
so
of
we
the
have a
main.
mentorship program and we help those folks do deals. We don't do deals outside of them. So
Oh,
yeah. But
so
let me put my I'm gonna put in the chat here. You can book a call with me and then we can go over it in a little more detail.
okay,
Let me
okay.
just find my link here. Hold on. Thanks for joining. We'll get started in a few minutes here. Glad you could join us again, Sheena. Feels like I just saw you.
I don't think she can hear you.
Yeah. Oh, there she did.
Everyone,
Howdy, howdy.
how are you?
Good.
Long time, right? Haven't
Yeah, we were just
over
on a
20
call
minutes.
together. And I'm gonna make you a co-host. John had to join and make me the host, but we're good.
And as I was getting in, I have like 3 calls back to back. I was like, everybody target for 6 p.m. Hey, Alex, hey, Shana. Just give us a minute. We'll pick it up around 6:05 or so.
How you doing?
But how are you, Alex?
Doing well. I still have questions, but that's what we're here for, correct?
Nice. I love those questions.
Mm-hmm.
Hopefully, we have answers. If we don't, we'll let you know too. Absolutely.
Yeah,
No shame for that.
I am sure you will. Yes, the answers are very important to me. It'll let me know whether I'm going to take the next step with you guys or what.
Wow. Okay. Okay. We're in test right now. Hey, like,
And Sheena, she remembers me from Cornelius's deal room, and she reached out to me last hour and said, "Is that still going on?" And I said, "No, we had a call today." And I said, I got another call for you to come." So she's in North Carolina. Well, she's looking in North Carolina. You're in Maryland right now, correct? But you're going to move back. So I was telling her about Bobby and the couple of deals we have there.
it's a great market.
Yeah,
Uh, Trevor, I miss the music. We're gonna
I
start
know.
next
I'm
time.
going to figure
I
this
want to add
out.
that.
We're going to have music and
I want to write that down as a checkup. So for everyone, full disclaimer underneath the hood is where we went through some technical process update. So we sent a lot of text out. So we figured out the process and email. So that's kind of it's delaying us to reach out to everybody. Hence, last 3, 4 webinar,
yeah.
our attendees has dropped quite a bit.
And then I
So we're
realized
trying to
that
figure that out.
the text didn't go out because John's
Yep,
time zone doesn't change. So I reached out to him about 5:15 and said, "Oh,"
I knew
because
it.
we're obviously we changed time and he didn't change time, and
Yeah.
he was like, "Man."
And then also we're trying to do a simulcast. So moving forward, we're trying to test out so we can stream on YouTube, Facebook, LinkedIn, all at the same time. Okay, I'm sharing my screen. Please let me know if you can see it.
Yep.
I
Yeah,
want to see
I
it.
can see.
Awesome. All right. So Trevor, we can maybe get started.
Yeah, awesome. And we started recording because I didn't get to be host till, so we're still recording. They'll edit it out. So thank you everybody for joining today for our Transformational Tuesdays. We do this particular meetup every other week. So hopefully if you find some value, you'll come back in 2 weeks and invite a friend. We also, on the opposite weeks that we're not here, our ladies group has a meetup that they're you can join and hang out with the ladies. We've got a really good group of ladies. So today we're going to talk about if you still have a job, but you want to get to be active in commercial real estate, what steps would you want to take, need to take? What things should you be looking to doing? And again, there'll always be time at the end for Q&A, but feel free to put them into the chat because sometimes they make sense to answer the questions where we are. And if we don't answer those particular questions where we are, we always have time at the end for question and answers.
Sounds good. Thank you.
All right, so this is an educational series. We are not offering financial, legal, any advice other than our own wisdom. And so you should always check out any deal that you're going to do before you would make any investment. You need to do your own due diligence. So today we're going to talk about understanding commercial real estate assets. We're going to map out some timeline and financing. We have a special invite for you. And again, we always have question and answer. And I always like to tell people, if you're thinking it, chances are somebody else is thinking it. A lot of people think, oh, I don't want to ask that question. I won't look like I know what I'm doing. That's fine. None of us, we all learn by asking questions. So strategy without tactics is the slowest route to victory. Tactics without strategy.
I would like to say this much. I'm sorry for interfering or interrupting you. I've invited 2 other people to come on this Zoom, and I'm wondering, I can't see them if they're here or not, but would they be included in this or?
Anybody you invited, you can just come in, yeah.
Yeah, so I mean, I can't see them on the screen anywhere like I saw some others,
Yeah.
but
what's her name?
One of them is Atis Woody Walls, and the other one is Jacqueline Woody.
I do not see either of them yet.
Okay. All right. Well, I was just trying to
I see an Alex Woody, so unless she's using somebody else's phone.
Yeah, well, she's using her own phone, and so it's Atis. So we'll see what happens. Hopefully they'll join. And they're here.
Awesome. All right. Very good. So strategy without tactics is the slowest route to victory. Tactics without strategy is the noise before the defeat. That's a pretty powerful one. Shahriar keeps digging these up. I don't know where he finds them all, but all the deep in thought.
Hey, strategy is like, it's really core of anything that we do, right? You got to have a plan, then you get your tactics, and we're going to go test out the tactics. Then the game gets fun, right? Otherwise, it's like, what am I doing, right? All right, Trevor, back to you.
Awesome. So a little bit about Massive Capital. We're a vertically integrated real estate company, developer of Class A retail town centers, owner operator of value add multifamily. You can see we're very heavily focused in Texas, but we do have assets in Denver, Colorado, North Carolina, and Atlanta, Georgia. We do partner on a lot of the development work with Realty One. And so you can see Realty One has about 300 million in assets under management. And then Massive Capital has about 210 million units under management. So it's pretty impressive. And we do LP equity for retail and family office, triple net leasing brokerage. So Realty One is also a broker. We do land development, steel frame construction, and of course we do have our massive masters program. I'll spit that one out.
Oh, Trevor, let me take it from here. That's okay.
Yep.
Thank you. So for us, all the investment that we do, it comes with risk, right? So I like to read, listen to podcasts. For Market Cycle, and Howard Marks is one of the person for Market Cycle. He has a lot of good publications.
Make sure you can do your own.
So you have a lot of, that's right though. I just told my son to do this. So good job. So back to it. So Howard Marks, he does a lot of publications. He had his quarterly podcast or so. If you want to understand about Market Cycle, dig deeper into it, please listen to him. Great. Every minute that you spend with his interviews and meetings, you're not going to go wrong with. And then, and this is one of the reminders that I have. It's investment success doesn't come from buying good things. It's rather from buying things well, right? It's slightly different as you take a look at it. And this one, even more fun. There are old investors and there are bold investors. But there are no old, bold investors. It's once you do a lot of investments and you understand the risk, you understand the cycle, then you tend to have a good eye on what a good things look like and a bad things look like, and to be a little more cautious At the same time, I've seen investors act at a Godspeed once they're older. That means they've been through so many cycles. They know what the bad looks like, but when the good happens, they go at a speed. It's like it's so fast, so quick. I don't know how it happened. That's there. Okay, so let's get started, right? The premise of this one is, or this webinar tonight is, how do we do real estate, especially in the commercial segment, as we have a W-2 or we have a business. That also means that, look, think about the units of measurement will be hours, right? We have allocated 35, 32, 60 hours to some other commitment. Now, we also not come into the commercial real estate. Now, the question is how. There's a path on the street, which everybody says to go about it. And also there's another path. When you understand the game, you can look at that whole game based on the constraint that we have, which is time, then optimize as you go. On that note, this is Jasmine. If you have signed up with our database, she gave you a call. She's our investor relations manager. She leads everything for us, and alongside with Trevor. And also she runs the webinars every other Tuesday that we have. Okay. So this is interesting because we want to do commercial real estate. We want to win in the commercial real estate. At the same time, our biggest constraint is time, then the financial constraint. And then we always say, take a side, right? It's if we don't know how the equation works, you plug in the number. And as the numbers change, you change sides, right? So our philosophy has been take a position, have an opinion, but as the data comes in, you should be able to optimize your opinion as you go, but don't get hung up on that one. So I want everybody to say, hey, take a side. In this case, let's assume we're going to be on the active side. Let's assume we have a full-time commitment somewhere. Flexibility, not flexibility, fine, but just understand there's a time limitation in there. And then we're going to understand that, hey, how do we go about understanding the commercial real estate? And then how do we position ourselves in terms of a time and what type of asset to buy based on what risk? And then at the end, I will spend about 10, 15 minutes or so. If we were to do a deal, how do you go about structuring a deal? Make it legally. All right, so quick recap. We all know the market cycle, 21, 22, 23, 24. One of the things that happened most of the time is when the market is high, you don't take loans, right? Or we take loans as less as we can. Well, then that means if the cash flow goes down, our debt payment is not high enough. That puts us out of business, right? That's what the book says, but the street did the other way around. And that's where most of the issue happened, right? So the whole point is, if you understand, we don't want to time the market. We don't know the market, but we should understand what cycle we're in so we can position ourselves to ride the wave, right? So finance perspective, and on the high cycle, take as less of a loan as you can, hoard up cash as much as you can. Now, it flips when the cycle is on the other side, which is today, which we've been talking about. So this is the time you take more loans. This is the time you do more deals. This is the time you put your hand on anything else. This is the time you shy away from being passive to more of an active side as much as you can. And don't listen to the market where everybody will say, take a fixed debt loan. No, this is the time. It's the worst that you can get. It's going to go sideways, then better. It's not going to go anything deeper. We expect a recession coming up. As you can see, everything is building up to that. We've been talking about it. And hopefully it happens quick. So if it happens quick, also we're going to go through a recession in the next 2 quarters. We're going to come back out. When the recession happens, your interest rate or inflation will go down a little bit, hopefully, and the treasury will go down, and things gonna get better for us. How long it's gonna take? A year probably. But the point is, we understand where we are in the cycle. So all the, this is the time we should get into as many deals, be active, and leverage up as much as you can. Right? That's our hypothesis. That's how we're operating, and that's our strategy been last year and this year. All right, so let's go back up a little bit, right? So usually we tend to think that come to commercial real estate mostly in multifamily, right? You do single family, you do a couple of flips, then you buy 20, 30, 40, 50 houses. That's a multifamily. That's a conventional path. The concept makes sense. 1 house, 10 houses, 100 houses, all together in a local one address. And that's how we have done it all the way. But there's also other asset classes that we don't typically talk about. Another thing is, as we understand the asset classes, we'll segment it out in terms of how operationally heavy they are and where you have the most amount of debt available. Then we'll try to cross-section and say, hey, everybody's different. I have my specialty versus Trevor. If Trevor goes to asset X, how do I compete with him on asset X? Or sometimes I'll choose not to compete, right? So I go buy asset something else. So I'll try to answer a little bit more about that angle and as you go. So multifamily, we all know about it. It's very conventional, operational heavy, but this is also the asset. This is one of the only asset classes you can take. You have pricing power. You can change prices every 12 months. You can increase the value of the asset. if synthetically, within a short time window. It has lots of debt available, and if you have the access to the equity, this is a good asset class to come in. But understand, if you have a W-2, once you hit the 70, 100 units count, you are going to spend time on the other side. This is, once you buy 2-3 assets, it almost becomes a full-time gig for almost everybody. Hospitality, it's a hotel business. This one has a lot of barrier to entry. Multifamily doesn't have barrier to entry. Anybody can get into multifamily, and most of us, we can get into multifamily. So we're competing on price and operations. Hospitality has some barrier to entry because not all the lending is available. But at the same time, if you have the specialty and if you know how to weather things out, hospitality could be a good way to go. Most of the folks that I know in the hospitality, they have a scale. That means they have multiple 4, 5, 6, 7, 10, so they can weather the market as you go. Special purposes, this is where things get really interesting. RV park, self-storage, then your mobile home park, it's all here. So one of my biggest realization, if you're looking for a cash flow, an immediate cash flow with less of a work or more of a sticky tenant, you want to go after mobile home park. It doesn't scale as much like multifamily, but cash comes in much faster before time than anything else. And that's a different kind of clientele. If that jives with you, then where you're okay with that clientele, you like to engage, you are hands-on, you don't want to scale, you are looking for a cash flow, and you're okay to have 2 or 3 assets and you run over tax, fine. This is a good asset class for you to get in. Now, RV park and mobile home park, literally you're renting out parking spots, right? And if you don't have notes on the mobile home, renting out parking spots, as simple as you can get. And those parking spots are leased by months or days, months or years, right? So it's kind of cool to have the mobile home park. Seen quite a bit of people make a lot of money with the mobile home park within a decent amount of time. Then we have industrial, one big building, one tenant, or one tenant with a lot of square footage. This is where the industrial comes in. One contract, long time, and you kind of know. Office, I wouldn't touch it today. But industrial, the barrier to entry is that it's a financing game first, then real estate. What it means is that in a multifamily or single family, if a tenant applies for residency or application, $35, we know everything about the tenant. And we get to say, hey, whether we want the tenant or not. Industrial is not the case. You really have to understand the quality and the revenue strategy for the tenant. And then you can understand whether there'll be a good tenant or not, right? So it's a little bit different. It's a finance heavy, it's a contract heavy. So you really have to understand contracts, contract structuring, revenue model of the tenant base that they're going to come in. That's on the big size. On the smaller scale, you have the flex mom and pop shops. You run the credit of the business. They give you a credit score. You ask them how much they make. You put 2 and 2 together, and you can tell whether there'll be a good tenant or not. So industrial, it's also a cool place to go. Retail, as you know, strip centers and shopping malls. We don't do malls. We do strip centers on the Valley Add, which is the suburbia Class A next to a major subdivision built by Class A or high-end houses. That's really working out. Now, interesting part on the retail and the industrial, most of them are triple net. What it means, tenants pay for the taxes, tenants pay for the insurance, and tenant does the management of the property, right? If you're a Class A or B plus, right? So if I have if I'm working and I want to have a cash flow, but I don't want to go to my tenant's house, I don't want to get a phone call, and I want to have one contract for 10 years or 3, 4, 5 years, industrial and retail, it's a great way to go. So now, if you think about it, what we said, know your asset class, just like the strategy, right? Understanding the game from your constraint, it tells us which way to kind of position ourselves, right? So for me, when I started, I went from residential to a portfolio of residential. Then I got caught with my work. I got caught up with my work. It was a big work. I could not do anything. I gave my portfolio to someone else, and then I went to land. Land is the leanest thing you can do. You buy the dart, it's a desktop exercise. You don't have to go. There's no battle, there's no fire, there's no insurance. We did well on the land. Then we came to industrial because I had my job constraint, right? I couldn't go to a multifamily, buy 100 units, 200 units. I got to be fair to my employer who's cutting me a check, right? So industrial, another good spot where I appreciated the fact when a manufacturer stays in our building, inspection is 10 minutes. We look at the contract. On the 4th, accountant sends the check to our bank account. Life is pretty cool. And then we got into multifamily and then retail. So whole point is there's a lot of ways coming into the commercial. The first constraint you're going to have is time. Once you look at that asset classes via the time, and then you'll have clarity. And then you may get uncomfortable. Hey, I was thinking I will do retail, but I'm operationally heavy and I'm about to leave my job and I'm multifamily. Or I'm running my business. I'm a doctor. I run operations. I have my practice. I'm really cool. True. And I want to do multifamily. Bad choice. Where I want to be active, even worse choice, right? So, but on the other side, you can allow people to enable people to get into multifamily via debt and equity. We'll talk about it. But operationally, understand that this is mostly the least amount, then the second least amount, then here a little bit hands-on. This is really hands-on, and this is really hands-on. So that's one way of taking a look at all the asset classes that we operate as you go, right? I am talking rather quick and dumping a lot of information, so please keep on sending your text on the chat box. We'll come back and cover almost all the questions. Okay, so let's say we pick an asset class. Hypothetically today, W2, I want to pick industrial. Right? No right, no wrong, right? So I'll do industrial and I'll run multifamily industrial side by side. Now the question is, fine, but I understand my asset class, then how do I get into it? Where's my JV structure look like? Typically, you'll have three different ways to come into we'll have 3 different ways to come into the commercial. You'll have JV or solo, which is less than 4 or 5 people. You do JV, or you buy one by yourself, or you be the general partner, or you be the limited partner. This is where the syndication comes in. So now you know your asset class. Now, second thing, I'd ask a question: how do I fit in? Or how do I come in structurally? And those are the 3 spots that you have. I don't think so there's anything outside, but most of the time you'll see. That's the thing. You can come in as a passive. You can come in as active. Or you can say, I'm the passive, I'm the active, stack it together. You became solo entrepreneur or JV partner as you go. We always say, look at the downside. Even though you may pull out a solo, try to bring in a partner, because everything is good when revenue is great, but things goes rough when revenue goes downside. So think about downside protection, even though you might not need somebody, but you want to ideally build a team where you can do JV. That not only gives you a downside protection, but also makes you stay longer. What I meant is that if I have a couple $100,000, I want to buy a $1 million property, I can take the loan, I can do it. So let's say I have done it by myself. Then I want to buy another one. Maybe my balance sheet will allow me to take a loan, but I'm out of money because 200-300 grand is a lot of money. But what if I have a friend, Tony, I'm just throwing some names out there. Tony says, Shahriar, let's go do JV 50-50, right? So we bought one, him and I will split 100 grand each. But the second one gets also easier. And then also what happens is I have my view of the world, I'm looking at a deal, and Tony has his view of the world, he's looking at a deal. All of a sudden, he's bringing in more deals to do with me. I bring in more deals to do with him. That's on the good side. And if, let's say, Tony and I, we just don't like to hang out with each other after 5 months, cut the cord, move to the next one. Earlier we found out better it is, move to the next one, right? So it is, our recommendation is, as you do deals, try to do as many JVs as you can, and then work your way up to this side. So almost everybody will come from this way, if not straight to the syndication model. All right, so recapping our asset classes, right? This is what we have. And now we're gonna go back down and ask the question, where are my risks at? Because my decision point when I am 25, when I'm 35, when I'm 45 should be different, because we all have an endpoint. And time is the biggest friend that you have and the worst enemy you can have. What it means is that if I'm 25, I can get away making a lot of mistakes, losing a lot of money, because I have life. If I'm 45, if I'm 55, I don't have much of a time. So depending on the asset class, as you understand what gets you more cash, we also need to understand which one has what risk, what type of return, right? So next couple of slides, I was at Best Ever Conference. I did a speaking engagement there. I shared the slide. I just took a snippet of it. I'll just go right to the mid of it. Okay, so what we call it, every project that we do, we have expected return and we have volatility, which is the risk, right? And you can map out how the portfolio will behave. What it really says at the end of the day, if you have cash, you have no downside risk, and your cash should give you, if you do it right, risk-free return. I'll talk about the risk-free return is. If you invest in debt funds or debts, it has very minimal returns. Very minimal downside, but you have a fixed upside. If you get into land, if you just do land banking, less downside, and you have moderate upside, right? Because you're taking a position, and now land, we're talking about all equity land, right? No loan. Then you're behaving like debt and equity together, so you have less downside and also moderate upside. If you get into pref, then you have fixed upside, but you have a lower downside, because our money sits on top of bank before the LPs. which where the LP equity comes in. So LP equity, the highest return and the highest risk. So now if I'm 35, if I'm 45, I'm 25, and if I have some money, I can ask the question, where is the risk? How do I mitigate the risk? How do I optimize my return for the risk? I get to pick and choose which asset classes we go in, how we go in, and how do we deploy the money as well. So next slide, I'll give you an idea of how much return that you should solve for. If you have cash, risk-free return today, treasury is 4.5. So you should put a CD and make 4.5. And if you're debt, if you're good investor on the debt side of it, you should get paid like bank 8 to 10%. If you do land banking, or if you give money with the high leverage to the land banking, 10 to 15%. Less of a downside, more of an upside, moderate upside. If you are pref, 14 to 17%. It's a standard. You don't have to calculate it, just follow the market. The banks already knows what they do. I just use the proxy. And if you have LP, it's 17%. One thing I didn't talk about is that what if you are if you're active, you should be able to add 10 to 15% here, 10%, 5 to 10% here, 5 to 10% here, 2 to 3% here. So if we are active today and we are buying a property, we as the LP and we as a general partner, then we should be able to make much higher return as as I forecasted here. That's because we're the one managing the risk. We're the one delivering the project, and also we're the one bringing most of the money. So quick recap, it was a lot today. So how we understand the market cycle, understanding the asset class, understanding the deal structure, and then understanding the risk associated with it. And then ultimately you got to ask a question, where's the deal flow? Everybody thinks they have deals. The answer is not everybody has a deal. Just because you know a broker, you don't get a deal. Broker is going to give you those junk deals if you don't know you, because broker is trying to see if you're going to buy something, right? If you don't have a track record, if you don't have a relationship, if you don't have proof, you're going to get those junky deals, right? And Crexy, LoopNet, they're there for a reason. Those are the locations where you can buy assets, or broker can sell to sophisticated buyers, then professional buyers, to any good buyers. Then they blast it out to LoopNet and Crexy and things like that, where we think just because broker picked up the phone call, all of a sudden, I want to get the best deal ever. So point is, if you want to be active, you must be in the deal flow. Relationship will not, it's not gonna matter. Depth of the relationship will matter. That means you have to show the broker you can make a lot of money for them. Broker have to believe that. Broker also have to believe that you are making a lot of money to other brokers. He wants to get a part of it. So his job is to find you the better deals. And so for us, Massive Capital, we took a position like that 3 years ago. So we do a lot of deals. Q1, we had a 200 some odd already. And then we actively network with brokers, network with a title company, network with lenders, network with other sponsors, and our masters do the same thing. So deal flow is an issue. In our pipeline, it's a little older snapshot. We have retail, mixed deals, flex space, land, storage, RV park, mobile home park, and existing multifamily. And as we get the data, we build an internal knowledge bank that we get to use for ourselves. All of a sudden, we get to compete with someone else who doesn't have this much of a data set. So we know a thing or two as we get into the pricing. All right, so this is where things going to get a little technical, so bear with me. So let's say you found a deal. We said we're going to do industrial. We said we're going to do, you're going to buy a $2 million asset, needs $500,000. You have 5 of your best friends. Now you're going to do a deal, and you're going to put a legal structure. And I'll show you how the legal structure works. Don't worry about it. As we get to know each other more, we'll do this. I'm not an attorney, CPA, anything like that. I'm just giving you a live case study of some of those ways that we structure it. Ideally, you'll be a more or less version of the same thing. Okay, so what happens? You do a syndication. If you do a syndication, every project will have 2 LLCs. Ownership entity on top. So the property, when you buy, you put the deed on the property on the ownership LLC. That's where the loan sits. That's where everybody's partnership, LPs and GPs, will sit in. That ownership or property LLC will be managed by a management LLC. The biggest mistake we see in the management LLC, you got 10,000 people. So a management LLC is just like going to work. You got one CEO, one COO, one CFO. They got a bunch of other people. Or if you think about sports, teams, there's one general manager, depending on the game and the play, a bunch of captains, but there's one GM. So management LLC is the one person who's spending the most amount of time on the asset. Other way, whoever is in control of hiring and firing the property management company, that's your asset manager, because that manager will make or break your deal over the course of time. That management LLC could have other in it, right? So you could have partnership LLC here, not CQ LLC here. I use some fictitious number, Shahriar, Sanja, and Mike. We got 33, 33, 33. We have not sure LLC, sorry about the name. It could be Trevor and Jasmine. All of us, we come together, go to management LLC. but there's one person calling the shots at the end of the day, even though I'm getting feedback from everybody else. So that's your conventional large scale on a syndication type model. Then if you do pref, it gets more technical, but usually on a GP/LP side, the ownership goes here, management sits here, management have a bunch of other GPs, then you kind of split out that we go. All the way, what's going to happen, you take that 100%, split to 70-30, 30 goes here, 70 goes here. And then on the management LLC, you should see how everything sits in. This is the org structure we do. We like it this way because once the lenders does it, lenders will do a background check. Whoever is the manager. So if I am ever in a doubt, happened to us before, that we want to know who the individual is and how they financially performed in their life. And they always say, yeah, be the manager, right? Let the bank do a credit check, do a background check, and tell us, whether we're looking at a good partner or not, right? That's it. This is too complicated. I want to do simple JV. I don't want to syndicate. You just take this part out. You just put it right there. Simple. You just put the property owns the JV and JV has two partners. That's it. However, will you split it? It's up to you guys. So this is not a syndicating partners. This is not a, you bringing money, operation, things like that. It's a simple JV structure as you kind of go about it. All right.
Just
to
clarify, in a JV structure, you can't raise capital from non-JV partners. This is where a lot of new folks make a huge mistake and think, oh, I'm not going to syndicate, but I still need to raise money.
Yeah. No, you can't. So JV means you are the LP and we are the LP and we are the GP. Since we are the LP and a GP, we collapsed the box. We took ourselves out from the whole legal structure, save a lot of legal fees. We went straight to the management. Yes, let me kind of reiterate. If you're a JV, that means 100% of the money is needed, is brought by all the JV partners. It doesn't have to be equal basis. Your share doesn't have to be an equal basis. You guys can figure it out, right? Sometime will happen. One of us will bring 80% of the money. We'll get 50% of the deal because some of the work the other party needs to do, I don't want to do. Or sometime we all bring in the equal share. 6 partner brings, let's say 4 partners bring 1/4 of it, but one of them gets extra one because that person will do some of the extra work. So it's a simple structure. Thing goes good, you guys high five. Thing goes bad, and you guys yell at each other. But crucial part is JV structure is very sensitive. That means you have to have a strong faith on that person or the team member that you have. This is JV structure. Typically, it's not where you go meet with somebody and one time, really like that individual, and you kind of go. Could happen, but typically it's a slow, drawn-out process. You get to see them in action. You get to see their style. You get to see their values. You get to see how they perform in their existing portfolio, how they show up. Then you build your confidence level as you kind of go. So we haven't done any JV, somebody who did not came from any vetted sources and or one of us, we have not done a deal with that individual. So all of our JV partners, we are sometimes I get to say, you know what, I have done X deals with that person. So Shahriar and Mike, you don't know, but I'm vouching for that person. There we go. And that's how we kind of go into the JV model. Yeah. So Tony, when I was talking about you, and when I was talking to you, this is the legal structure, how you take a look at it. Now, if you are a operating partner where you want to have your friendship LLC here, that could be different. This is just for the property. What I meant is that if Trevor and I, we have a JV partnership, 50-50, everything that we do 50-50 there, but we're going to buy a property. Trevor draws everything. I don't do much. I just facilitate the deal, did some stuff. He's going to take 75% of the deal into that LLC, even though roll-up LLC is 50-50. So always remember, when you buy a property, it's a deal-by-deal legal structure. When you have a joint venture LLC, that could be for eternity, but that does not mean every single deal that you do must follow your partnership LLC. Okay, so two differentiating factor. At the project level, every deal is different and every deal structure could be different. You want to set up every single commercial deals in a separate LLC. That may not be your partnership LLC, right? Which is different. That way, thing gets clear. You have way in, you have way out, you have a way to dissolve the partnership, you have a way to improve the partnership, you have ways to bring in more partners, you have ways to reduce your partners as well. Okay.
Thank you.
So I'll come back after the question. Once I go through a couple of more slides. If you have more questions, I'll walk you guys through. So on that note, what we said, hey, we got to take a side, be passive or be really active, right? So this is our invite only event that we do in Centurion Expo. Next one is coming up in Dallas on 28th. It's invite only. It's about 50 people. And we spend 3 days together. We review all the asset classes and we do case studies, then underwriting, deal structuring, both from the debt side, from the capital side, from the finding side, and also example of where we're structuring and where we're getting more benefit today versus tomorrow, and how you can get into the commercial side. right? And as we always say, talk has no value. Ideas are dime a dozen. If you don't take the next step, we are nothing, right? So all things begins with you. And I'm open for Q&A. And again, thank you for bearing with me. And there was quite a bit. I want to cover as much as I can, but again, we can go back and review some of the questions.
And it will get uploaded on our YouTube channel, and please subscribe. And then also, if you do want to see what deals, there's no obligation when you sign up on our portal. Just gives you access to see any deals from Massive Capital. So please sign up there as well.
Okay.
Awesome.
So let me see questions we have. Okay.
I think we got all the questions. At least we're in the chat.
I know Tony got questions. I know he want to talk a little bit
Tony's
about it, right?
Yeah, this is first and foremost, ladies and gentlemen, thank you for allowing me to be here. I have very close friends that we're looking to do some deals together. We've all done our separate transactions together. We both are real estate, all three of us are real estate investors. And they have 2 new babies that I'm Uncle Tony for. So I feel like it's time for us to do some stuff together, because I've been knowing them since I was in the Marine Corps. So yeah, I think the one question that I have is finance, right? And I know that you're probably going to get more in depth to that. That's the only part that I feel. And Ian and Bruno is here. They're here. So we're looking at a couple of deals to knock down, and we're just trying to figure out. We do have the cash, right? But we're looking at if we should finance the money that we need or leverage our own capital. But I know if we leverage our capital, then we're non-liquid. I just want to see what your opinion is on that.
My personal opinion, I play with my money first, then and everything else. That way I have my skin in the game. And if the project, I am incentivized to make the project work, and then we kind of go. Sometime I'll ask my friends, hey, I invested, invest with me as you go. But we don't recommend for any sponsor coming to especially a commercial deal without the money. It's just tough. Things are great when you make revenue, but when the downturn happens or cycle happens, the performance and the characters will show up. But on that note, I can always say, when we need money, we don't usually need money, but when we need money, we need the darn thing. And that alone break a lot of folks. I've seen that. We have been there. So our recommendation is, as a sponsor, bring in at least 10%, if not 15, 20% of the total equity needed, and you can get backing by the other investors. Now, that alone, though, in a syndication model, which is this model, and that's a full-fledged SEC regulation. It's a full-on syndication model where you have to go talk to the SEC attorneys. They're going to come back and structure you from the GPLP side. It's a whole process you got to look at.
You will always combine that with bank debt, some sort of debt, some sort of third-party debt. Still your cheapest money. You're still going to need that leverage, but you're still going to need cash as well.
And on the debt side, depending on the deal type, depending on the asset class, depending on the leverage, everything will be different. On that note, what we have seen is that weight or leverage in a negotiating matters. We're massive masters, massive capital. We're doing 3, 4, 5 deals a year, maybe 10 deals a year. So we have a lot of negotiating leverage when you go to a broker, go to a lender, that, hey, we're going to show up 10 times. We're going to show up 5 times rather just do 1 time. And so if you help me with the rate, we can kind of talk about it. So we have vetted out a bunch of brokers. We have a handful of good friends and a good spot. And we are actively shopping debt terms and equity terms and pref terms all the time. So on that note, if you're looking for 1Zs and 2Zs, your expense will be a little bit higher, which is norm. But if you belong to some kind of a platform where they're actively looking for deals, and they may have the pre-negotiated rates, that could help you, ease the burden of the project as well.
And plus the volume gives you access to more lenders, right? So we have everything from local banks to federally backed loans. Again, you can bring all of those things to a deal. Todd asked for a little bit more description on how you can make some money on the active side, right? Because we've talked a lot about the passive side, but there is a way when you're on the active side to be able to, you get a portion of that 30%.
Todd, thank you for asking. So let me go back, right? My return was based on the LPs, but for LPs to get the return, GPs have to get paid, because those guys or girls are working for 5 years, right? Time value of money. And none of you guys should work for free. We have seen a lot of times just to get a deal, get the emotional thing out of the way, you squeeze out everything to the LPs, and GPs for 5 years don't do anything. That means you'll have to do 10 deals. That means you don't have time to manage your deal. It's problematic, right? So on that note, what you want, that if you're a sponsor, there is a value that you create. Let's say 10 to 15% of the overall profit goes to you, because this is where 30% of the profit goes. This is where 70% of the profit. So on that note, if the LP is making 15 to 17% return, and you have two hats, LP hat and a GP hat, then you can stack your 10% on top of your 17%. So you should get much higher return because you're stacking two roles together, LP and a GP. And that's how you create more value. If you play with your own money and you're playing it from the active role.
And that 30% can be split up differently on every single deal, right? Again, deal by deal. So it's based on who found the deal, who put it the at-risk capital, who was able to guarantee and be the KP on the loans, who had the experience, who raised the capital, who's the asset manager. All of those buckets get split up by roles and responsibilities, and it's a team decision.
Thank you. And on that note, when you look at the SEC syndication stuff, we look at the whole project as a 5 years of ownership, and then you look at the blended approach of everything. I'm not an associate attorney, consult your attorney as you kind of go through. Another question I have, joint venture partner. So this is where it's gonna get tricky. When someone says joint venture, right? And the question we have to ask, joint venture, what type of project, what type of loan? Let's say you do a retail space, $10 million. Retail or bank loan. That means I have to pledge everything minus my family. That is a different notion than maybe a multifamily, which is a non-recourse loan, which a deal goes south, stays in the project, and we move on. If you do a JV on a retail, all the partners who has more than 15% or 19% ownership, they gotta be comfortable that we're gonna take on this loan for the next 5 years. And all of us, we gotta be okay with it. Because if one of us mess up, then all of us will mess up. Because when you try to sell, everybody has to sign, right? Versus multifamily, you can have one big portion can take the debt, and they can kind of have the general partnership and the limited partnership rights. It's easy that way. So on the JV side, it gets really touchy. Because of the risk that you take. It's not the people, not the money, it's the risk. So I'll give you an example. If someone comes to me and say, hey, we're going to buy a $10 million asset, I'm going to put down $2.5 million. I'm going to go run it, Shahriar, take the loan. I mean, if you put in $2.5 million of your own money, not somebody else's money, and you're running it, and I know you're going to cry if you don't do a good job, I'm okay to take the risk. Versus you come in, we say, hey, I know one of my best friend, Tony, he got the $2.5 million. I'll take the money from him and I'm going to go run it. Sure, you take the loan. Theoretically, you solve the problem. But do I see it? What if something happened? We had a tough, man talk, and you say, what, screw it. This is the key. I walk away. So you have to put the GP team structurally so nobody can go. You really have to kind of tie it together. And that's what it is. So on the JV side, you can use your friend's money with your minimal money with everything else, but you got to take some additional risk somewhere, maybe the loan you take, and it can offset out. So you get to say, hey, you take the loan because it doesn't work out, then you're fine. I bring the money, perfectly fine, because I know I am in and I know you're in. So we kind of do the deals together as you go. And bigger it gets more sensitive. Smaller it is, it's fine. You can do those, other people money all the way without you bringing in $1 for single family, for $500,000, $1 million, $2 million deals, but you cannot replicate that over and over as you go. Because if you bring in a JV partner, as the deal gets better, they're going to ask more control. You'll end up working for them. If you bring in a large enough JV partner, they're going to say, this is your job description. This is your KPI. This is what you got to do. This is what you have to perform. And if you don't, you're gone. I'm coming in, taking up. But long way of saying though, on that way, that hey, sorry. There is a way going about it. There is a way making things simple, as long as you have case studies and examples and everything else. All the things that I talked about here, for us, it's one email. SEC attorney, this is my deal. This is the debt and equity. Those are my name of the partners. That's the structure I want. 15, 20 days later, I'll get an email with the stock document. Rollo knows what to do. I know what I asked for. We went back and forth 5, 6, 7, 10 times. That one email. Hey, by the time you're underwriting the deal, we are also in our mind underwriting the lender. So we can say, okay, this goes to that bank, that goes to that bank, this goes to that broker. By the time we get down to, with the LOI, get ready to do PSA, we got the term sheet already. So from that perspective, don't try to figure everything out, even though you can, because everything you figure out will cost you money and time. Everything. So on that note, make your life easy. Hang out with whatever platform you want. You want to know more, you can come to ours. But then you can run simulations. And the best thing you can do, You can also look at all the case studies that we do and then say, you know what, that's a case study I want to go follow and rerun that as example. We're trying to put a land under contract. We're trying to do the structuring, but we're not trying to figure it out. We're trying to use one structure we used from last. We have an apartment under contract. The person who did it, that was its first deal. He went right to the $7 million deal. We're guaranteeing. And we made all the introductions. We made all the relationships. He underwrote it. We liked it. He liked it. He's raising the money. We're covering the debt. He's going to run it, goes quick, right? So make your life a little bit easier. Don't make it too complicated. Don't let it burden you. Find a good group of people that you like to hang out, and they're actively doing deals, and good, bad, or ugly, and they're talking about it in front of you. And then you go. Alex, hopefully I answered your question a long way. Good. What else?
Well, I was still wondering about the LTV portion of a deal. Do you guys also include that, or do you have to come with your own? I mean, I can get fined for the LTV, of course, but I'm wondering if the group will also participate in that portion of it. And if so, how much of the deal will I still get out of the NOI from the property after coming in with a bare minimal amount of money?
Got it. So from the massive side, we don't do deals outside the massive capital and massive masters. We have enough deal flow. We have enough partners. We practice together. We break the bread together. We negotiate with everybody together. So when a deal comes in, everybody has been vetted, deal has been vetted, a lot of things has to come about. So, which is also why what we call it, for us to do a deal with someone, it takes at least 3 months to get to know each other. That's part A. Part B, asking to your questions about who gets what, about doing whatever deal that we do. That's a handshake. And there's a framework of going about. What you should ask is that, okay, how much work is needed, how much risk I'm taking, how much of a time commitment I have, then how much value I'm creating. Then does it make sense for me? So Alex, once you solve for yourself, then you can solve for the others. It gets easier now, right? So I'll give an example. Let's say we do a $1 million deal, right? Or let's say $5 million deal. We need about $1.5–2 million. Let's say $2 million needed to do a $5 million deal, and we're going to sell the project 3 years from now. We'll make $7 million.
Okay.
Right. Then you ask the question, okay, 3 or 4 friends, Alex, you and I and Trevor, we brought in $500,000, and then we split that $2 million amongst all of ourselves. But then you say, you know what, Shahriar and Trevor, you're not going to do all the work. I'm going to do it anyways. Can I get a little more? We'll be like, yeah, of course, have a little more, right? Then you come back and kind of talk it through to see what makes sense for Trevor, what makes sense for me, what makes sense for you. And from there you go. So that's an art of negotiating. And how you go about that also says a lot of things about how you think about the world. And then you can sort of take that and try to put a good team together where everybody's helping everybody to create a good value.
Okay.
So long way of saying, Alex, it's a conversation you got to have with your partners, whoever you want to work with the deal on hand, which could be a fictitious deal. It doesn't have to be an active deal. You're going to put a contract tomorrow. You can always say, you know what? Let's find the deal. Let's assume I found the best deal ever. God just gave it to me, and we're going to go buy it tomorrow. If we were to buy it tomorrow, what's going to happen, right? You can always simulate that scenario.
Okay. Would I have to come to a workshop in order to meet prospective partners in order to get the deal going? And do I have to be on an inside of your group in order to meet these people?
Yes. For us, to be inside our circle, the first thing we do, we go through all 3.5 days of all the asset classes.
Yeah.
Then you figure out what asset classes you want to go fit in. Because when you come in, typically, Alex, you have your hypothesis. After you go through it, maybe you'll stick on the same asset class, maybe you'll change, and then you decide which way you're going. So I'm sending you a link on the chat. You can just fill out the form. Olivia will sit down for 10–15 minutes with you. She can talk to you really, really quick, and we could say, hey,
well, I also heard that, you mentioned a possibility of leasing parking spaces. Now, what I also do is I install EV charging stations for those that have electric cars, and I'd like to get in specific areas that have high populated people living in that particular area, and that makes it very profitable for me to put a EV charging station there. Now, I'm wondering how I get to choose these parking spaces. Is it something that you present? Is it something that I give you? How does this work?
I gotcha. Thank you. Okay. Now, before I get into that,
yes.
What type of asset class you were thinking to do your deal that we just talked about a couple of minutes ago?
I'd like to do a multifamily.
All right.
Commercial.
Okay.
Property, yes.
Okay. So your hypothesis was, I'll do a multifamily. How do I do a deal together?
Yes.
Then you heard me something about parking lot, and it got stuck on your head. You want to know a little bit more about it.
It did.
That's the beauty of going through all of them before you design whatever they're good for you. So parking lot to us is mobile home park.
Mhm.
So mobile home park, if you do it right, you can own a 50 pads, 100 pads, location, and tenant brings their house on top of that. You just charge them 400, 500, 600 bucks. That's it. I mean, and if they don't pay the tenant, you call the sheriff, they kind of tow up the house, and that's it. There is no eviction court. There is nothing. It is as simple as that. So
I
if you
see.
like the parking lot, less stuff, hey, but then the question becomes, you see, okay, is that the asset class you want? Is that the cash flow you're looking for? Are you comfortable with it? We all have our own biases. We all have our own comfort zone. You try to match it alongside with the constraint. So mobile home park is a really good place for you to kind of come take a look at it. From the deal sourcing, we do active reach out to lots of brokers. And then once you go to the underwriting, we made introductions. Then you kind of go run with that introduction.
Do you have a list of properties besides mobile park that are available for leasing? Park?
Yeah, the hard thing with the EV charging at apartment complexes, it has to be a revenue generator. So you know, like normally, again, we put covered parking and we charge for it. We have reserved parking and we charge for it. Now, if we're going to have EV charging stations, we have to figure out how are we going to charge for it and make money on it, right? Because those are profit centers. And again, value add C-class multifamily, you'd be ridiculous to put a charging station there because they're driving 20-year-old pickup trucks. I'm a passive investor. Hopefully they'll get it built one day. I have an apartment complex right behind the Tesla factory. Well, I think that's a pretty good spot to have some Tesla chargers, installed,
You
So
understand what I'm
again,
talking about.
yeah.
And then,
but it has to be a value add. You have to be able to say it's going to cost me X to put it in. I can charge Y. And that creates a net operating income of this. And then that times how many ever spaces I have. And the hard thing is, you're never going to put it on 300 spaces. You're going to put it on 10. How are you going to do it? Even on that parking lot, they talked about putting a Tesla solar panel covered parking that would charge the EV state. I mean, but again, unless it makes money, it brings no new value other than if you're in a real urban center with lots of people that are driving EV cars. And that's the decision maker to move there.
Yeah. Well,
mostly premium properties you have there.
Yeah.
And you can run numbers with the high traffic premium properties, come up with the value chain. You go. But that's something we don't do. So just to let you know. Okay. So I had another question is that, in my opinion, what is the easiest asset class for beginners? I look at it the backing way, right? I think someone just, sent me the question directly. I look at backwards. So for me, I try not to front solve, which is I show up, then I try to make a good thing out of it. Then I go to next one and next one. To me, I back solve. That means that we ask the question 5 years from now, 10 years from now, what is a good one looks like? Then I will go see, hey, today I'm here. 5 years from now, I want to be there. For me to get there, those
You guys
couple of
talk
things.
too much, man.
So those couple of things has to be true. Then we go out there, do it. So on that note, the easiest asset class for beginners in the commercial would be lender, be debt. I mean, you give the money for 2 years, 3 years, and someone pays you the payments, and something goes south, they get your money back because it's backed up by an asset, and as you go. I've seen some of my friends made a lot, not made a lot. They made a big chunk, but they had a big portfolio of equity that they have deployed, skinny margin, but it's a very downside protect. On the other side, I want to grow my portfolio, so I want to be active. So I'm trying to build my portfolio in terms of warehouse, retail, and multifamily.
okay. At this point, I'm thinking that I'm going to pursue doing multifamily or either commercial office space buildings with you guys. And I'm going to sit back and listen to you more and more about that, because I still have the concern about a joint venture partner with coming with down payment, closing costs, and how much LTV I'm going to have to come up with, if any, what I'm going to receive a day.
Yes.
And I'm not going to bombard you with any more questions. I'm going to let you go ahead and continue to talk, and I'll absorb what it is that you're talking. Thank you.
Alex, what you're going through, all of us, we've been through the same cycle, right? Information, gather. And I tend to say, look, there are 3 ways to play the game. I can be on the sideline and watch the game. I can be in the front line, I can be in the game. Being in the game is the price, right? Go be in the game, go practice. Go practice with fictitious project, with fictitious JV part. Alex, if you want to really do a deal, just take a deal, good, bad, or ugly. Call the people that you want to do JV with. Make the pitch. If you don't know, put yourself into the path where you get to find other people who are thinking the same way, which is, that Accenture and Expo that we designed. Good question. Thank you.
All right, real good. Thanks.
Thank you.
Awesome. So in theory, we're at the top of the hour, but all that means is if you enjoyed yourself, if you learned something, come back in 2 weeks with a friend. Our goal here is to provide value, to provide a place where you can learn, you can ask questions. You know, we have a topic, and then as you saw, we talk about just about anything, after that. So we appreciate we got a good turnout tonight. We were a little late on our text with the time zone change because our person that runs their IT doesn't change his time zone. Someday, hopefully, we'll stop that.
Yeah. I mean, look, it's like I have a lead that came about earlier this week. It's a mobile home park close to Houston. In a good side of Houston. I'm going to go walk the property on this Saturday. In my mind, I already have a couple of people that I work together as a partner in mind. I would have dropped them a note, timed it up. If the number's okay, I would have got the team ready. If the number is okay, if the number doesn't work, right? That's the beauty of practicing with others where you know what they want, they know what you want. You role played how you're going to do the deals. When the time comes, you can pull the trigger and the last thing you want to do, that's for everybody, follow the conventional path, which is YouTube University, free template, put something under contract, and then you go shop for partners. Worst thing you can do, because what happens? You have 90 days to close, and you're trying to figure out who's your offense, who's your defense, who's your quarterback, trying to figure out who gets paid what, trying to figure out who is a lender. That's a big risk that you have. So we said, flip it the other way around. Practice with the people that you want to go play the game. So when the time comes, you know who to call.
Yeah, and interesting too about getting out. So how many deals did we look at last year? How many LOIs did we? I think with 1,000 deals, 100 LOIs, 30 went to negotiation, and we closed 5. Okay. You got to kiss a lot of frogs for deals and sometimes for partners. And then eventually, if they don't turn into a prince after you kiss them, you may not want to be a partner.
The old and bold investors. I'm like old now. This is funny. Yes, and it's the whole point. I can't emphasize enough. Practice with who you want to work with. Avoid as much as you can where you go shop for the friends. Because guess what? If the friends comes in the T-1 day, as I got the money, I want everything, and you work for free, chances are you'll do it just to get the deal done. You don't want to do that.
And if at all possible, do some passive investments to get some experience on the other side.
100%.
Myself personally, I'm a passive on 20 deals. And I learned a lot. I learned about how I want to be treated as an investor, how I want to be spoken to. So it's a really good way to get started, right? To be able to passively invest and just start to, I call it earn and learn, and get an idea, and especially if you're thinking of joining, look at investing in, if you're looking at join, however, just that gets you in the inside of the room versus looking from the outside in all the time.
Tom, you've been kissing a lot of frogs already, big guy. You started. You came out the door kissing.
Love it.
This is awesome.
Yeah.
Yes.
Awesome.
Anyway, cool. Thank you, everybody.
Thanks everybody for joining. We really appreciate it. Hopefully we'll see you all again. We put links in the chat to book calls with us. We love talking to our investors. We love connecting with people. If you're in the Texas area, at near the end of the month, I'm doing a property tour at one of our properties in San Antonio. We're going to do, we have a development deal in San Marcos. We have a retail deal in Austin. So we'll be starting to post those on our Facebook page for people to come. And those are all educational tours. The whole goal is to answer your questions on variety of asset class.
Thank you, everybody. Have a wonderful
Thanks.
rest of the evening.
Have a good night.
See you guys
Thank
next
you.
week.
Take care, everybody.